This is the first episode after the Tesla Battery Day. I want to talk about the key takeaways and our expectations for the stock. This is the Not Even Wrong podcast. It's September 22nd, 2020. This is Krim Delco. Since the last update on September 18th, the fund is down 12%. The market is flat. For the year, we're up 201.5%. The market's up 2.5%. We're outperforming by 199%. The event today, I think, is one of those big events that will go into the history of Silicon Valley and I'm sure, will be discussed in the context of, in the short term, people get overexcited about technology. In the long term, they underestimate its impact. I think this is a perfect example of the problem that people have of grasping what's going on, of putting the right reference point even to look at what's going on. So let me dissect what I just said a little bit. But first, let's talk about the facts. So Tesla has announced a new way of producing battery cells. And the reason they do that is because they said that the current technologies and manufacturing methods are not enough to accelerate the transition from fossil fuels to sustainable energy. Sustainable energy means renewable energy. That means wind and solar, primarily, maybe some other stuff, but these are the main two energies, and in particular, solar. And in order to get renewable energy, you have to deal with the intermittency, and intermittency can only be solved by batteries. So in order to produce the kind of battery volumes that are needed to replace the whole world onto renewable energy, Tesla estimates about 200 terawatt hours. Now, of course, that can change, and the efficiency can change, and also it can go up because we have China and India and countries like that which might use more energy than they use today. But it doesn't really matter, because today the battery production is something, I don't know, maybe 300 gigawatt hours or something like that. So we're looking at several orders of magnitude of increase in production. So we're talking about a massive increase in production, and a massive requirement for cost decrease also to drive volumes. And this, combined with the situation that we're in the transportation sector, where we're also competing with ICE cars that are still relatively competitive, has brought Tesla to the point where they said that the current technologies which are used today, which have been, I would say, started with the foundation of Tesla, so about 15 years ago, those technologies are starting to level out. The sort of the Moore's law of battery technologies, if you will, has reached levels where you can't get much more efficiencies, or where the initial marginal effort is not delivering the marginal result that's required. Hence, the need to re-architect everything, to rewrite everything from scratch, and start from a new clean slate to improve costs. And this is what they did with this new battery technology. So they went through all the steps, or most of the steps that are necessary for this new battery to be easily manufacturable, at low cost, and at scale. These are the key components. And just to give you an example, they even brought the head of construction at Tesla on stage, so the person that's in charge of constructing factories. And he made a statement which stuck in my mind. He said that when Drew Balino, which runs the battery technology engineering, when he has an idea, it comes to me, because it's not just about how to produce the batteries and how to implement manufacturing technologies to produce the batteries, it's even how to actually construct the factory to implement the manufacturing technologies to produce the batteries. So this is how deep and vertically integrated Tesla is. And it's just an example of how all the pieces have to come together to drive efficiencies. This is unfortunately not like the semiconductor industry, where you get Moore's law just by having somebody like Intel doing what they're doing. You need a rewrite of the architecture, and that's what they did. And they expect efficiency gains of 50, 60, 70% over time, and therefore also a massive reduction of cost for the batteries. Now, this, of course, affects the car, and they talked about a $25,000 car. Now, they weren't detailed about what that really means. Does this mean the Model 3 is going to be $25,000, or is there a new Model 2 or something like that, which will be $25,000, and we'll still have the other cars that will be more expensive. Plus, you also have the possibility, and this is our expectation of the Orange Capital Partners, that you will have the lowering cost of hardware, so the actual cars will get cheaper, but the value will be increased through software, entertainment, UI improvements, network improvements, charging improvements. So you'll have a bit of an effect like you have with iPhones and laptops, where the cost will come down, but the value will roughly stay the same. So if a Model Y maybe will go down to $42,000, $40,000, but then stay there. It will not go down to $20,000 just because the hardware cost is going down, because they will keep increasing the value. So what you get for your money will go up, but not necessarily the money will come down. Anyway, having said that, long story short, Tesla is re-architecting the battery technology in order to be able to scale at lower cost and higher volume at the same time. This is the key takeaway from this event. They want to go to 2 terawatt hours in 10 years. So that's about 40x from today's 50 that they have at Giga Nevada. Now, Giga Nevada is supposed to be expanded to 150. I don't know about the timelines there, but from what we know, 50 is in place, and to get to 2 terawatt hours, you need a 40x, which is in 10 years about a 45% CAGR. So we're looking at and this number is very, very important. 45% CAGR in battery production. For another number they gave is car production of 20 million. 20 million cars is about 40x from this year's 500,000. So we have another 45% CAGR there. And therefore, well, if you look at this number, you can also extrapolate that probably revenue should grow in that range. Now, Musk actually tweeted that he expects revenue to grow faster than that. But let's not get too excited. 45% revenue growth. This is the key takeaway from this event. This company is still on trajectory to do 40 to 50% CAGR, which is 45 on average, which gets you to about 40x in terms of production, in terms of battery production, car production, and well, about sales. Of course, you have to make more assumptions than that, but typically what follows is if you produce more, make more, you also have more revenue. So let's assume they do have the same amount of revenue growth, and one way to explain that would be that software fills up the ASP declines and actually could even compensate for that. So having said all of that, I think the key takeaway again is that we're looking at a company with about a 45% CAGR going forward. This is our assumption, has always been, by the way. Of course, this year was tough. This year they're growing about 35% CAGR, and therefore it's a bit lower. The stock, however, has 10x because they've shown that they can do 35% CAGR in a COVID year. They should be easily able to do 45% CAGR. That's why the stock has gone up so much. If you now look at the valuation of the stock, we can say that maybe it's not going to be a 45% CAGR from now on or a 40x, because there is some expectation in there. So if I'm a bit less enthusiastic about the valuation of the stock than maybe other people in the market, and I assume that I get to sales of roughly 40x from now, which gets me to 1.2 trillion. So 40 times the 30 billion I expect this year gets me to about 1.2 trillion. I do a 3 to 4 times X on sales, so I get to between 3.6 and 4.2 trillion market cap. Sorry, 4.8 gets me about a 4.2 trillion on average. And that compound down to the 400 billion today would give me about a 27% CAGR. So what I'm saying here is that I expect the stock to grow a bit less than sales or volume production, just because we have a bit of a higher expectation now already baked in the stock. But given that we have a zero interest rate environment and all the other macro issues that we've discussed at length in other episodes, such as lack of growth, ESG, demand for assets, etc., it is very highly likely that the stock will probably outperform and maybe do more, maybe not the 45% CAGR, but something higher than 30% CAGR. And that obviously for us is a fantastic investment. That's why we're still very highly concentrated and invested in Tesla. I want to emphasize two more points and talk a little bit about the stock, and then I'm going to go into more details in further episodes about the technology, about the roadmap, about the problems we see, the upside, the downside in technical terms. But I want to emphasize one thing. I was very happy to see Drew Balino up on stage with Elon Musk with a confident, strong performance. I hope it's real. I really hope that Musk is able to build that bench and continue building that bench. I think Berlino is a fantastic example of somebody that's been with Tesla for a decade or more and has turned into a specialist in a very focused problem, which is building batteries for Tesla. And that's exactly the kind of bench that Tesla has to build. Tesla has to hire from internal. There was a question in the Q&A about hiring. Tesla wasn't exactly answering the question the way I liked it, because they said that they don't have a problem hiring top talent. And I agree with that. Tesla doesn't have a problem hiring top talent, but how can you create a culture where top talent can be keep building your innovation stack, which requires a non-elitist sense of urgency and humble type of culture. It is very difficult to keep hiring elite people and then put them in a culture that is not elitist. So I would have liked to hear more about that, and that's something I want to suggest to Tesla going forward. Actually, they should do a human resource day, because people will become more and more crucial to the success of Tesla. So number one, right now, I'm happy with that. They brought on Drew Balino. He gave a presentation, and then he also spoke. He brought on other engineers, and they all looked very capable, normal type people, not arrogant a la Google or something, where they go on stage and babble with jargon and try to sound important. They were just normal people trying to make it clear to everybody that this is happening and that they want to increase this production because they have a mission to fulfill. The other thing I want to mention is the importance of vertical integration. I think vertical integration is one of those words that by now we say like network effect or disruption. We just say it, but it really means a lot to Tesla, because you cannot do what you're doing. And this is a bigger theme that I've come across. I just finished Chip Wilson's book about Lululemon. I've read the Innovation Stack, the Square co-founder wrote. And if you just look across the world, even biographies like Walt Disney's biography, which is phenomenal, or even Rockefeller, if you go back there, or Edison, it's always about controlling the supply chain on every step in order to fulfill your mission. Now, Tesla's mission is so grandiose that they have to go back, and they mentioned, for example, even having not a say, but they have opinions about the way the mining should be happening, because the mission, of course, to get to sustainable energy cannot be fulfilled if you, let's say, if you just have totally dirty mining. Now, they spoke about recycling and the less and less need of mining and these kinds of things. But I just want to emphasize that you cannot build an innovation stack if you don't have vertical integration from A to Z. There are things you can open up when they commoditize, and some things you can let them be commoditized, because you might not see a curve where you can keep driving costs down and quality up. That's possible, and that doesn't mean it's the end of the story. But overall, I think even particularly in a situation like Tesla, where the mission is, again, so grandiose, there are so many levers where you can innovate and get better, that we believe that the need to commoditize certain parts of the value chain is still far away. So in other words, Tesla will become even a more highly integrated, vertically integrated company, and that's a good thing. That is an unbelievably good thing. I just want to remind people, and I think I mentioned that already on the podcast. If not, I want to say it now. For example, Chip Wilson, as long as he had power within Lululemon before he got kicked out, was fighting tooth and nail to keep manufacturing within the company. Once manufacturing got outsourced or kicked out by other management, the quality issues started coming up, and it just became a disaster. And I think it's a nice little example. It's a clothing company. It's not trying to change the energy equation of the world, but it still means a lot to me as an investor to see an example of giving up vertical integration and then losing quality control. And this is, hopefully, it will not happen to Tesla for a long time. I mean, you can't always keep everything in order, but you can manage the company in a way to reduce the probability of losing the grip on your mission, and that, I think, in Tesla's case means more vertical integration, and they are absolutely committed to that. And this is very, very, very good for shareholders. So to summarize, we are still on track for mid-40s CAGR for the next 10 years. The mission of Tesla has a chance to be accomplished. In Elon Musk's words, the results of Tesla will be measured in how many years it takes the world less to transition from fossil fuel to sustainable energy. And on that track, I want to just mention Bill Walsh's book, The Score Takes Care of Itself. So as a shareholder, I'm not concerned. As long as they follow their mission, the score, i.e. the stock price, will take care of itself and the market value will increase. And we can also follow our mission, which is to generate wealth by this investing in disruptive technologies with large impact. This is exactly the kind of company where we should be highly concentrated in. Thank you.